Have you ever wondered how some small-cap companies quietly become multi-baggers, while most investors are busy chasing large-cap stocks? The truth is, some of the biggest wealth creators in the stock market started as relatively unknown companies. The challenge is identifying them before everyone else starts talking about them. Today's company is one such business that has been quietly making headlines because of its impressive growth. It's called Hind Rectifiers, also known by its ticker symbol HIRECT. Now, if you've never heard of this company before, don't worry. That's exactly why I wanted to make this video. It isn't one of those companies you hear about every day on television. But when I started looking at its financials, business model, and future opportunities, I realized there's a lot happening behind the scenes. So today, let's understand what Hind Rectifiers actually does, why its growth has accelerated so quickly, what risks investors should be aware of, and whether this company deserves a place on your watch list. Let's begin. First of all, what exactly is Hind Rectifiers? The company manufactures electrical equipment used in railway locomotives, metro systems, power infrastructure, and industrial applications. If you think about India's railway modernization program, it's one of the biggest infrastructure projects currently underway. The government is investing thousands of crores into upgrading railway networks, electrification, high-speed corridors, and modern locomotives. Companies supplying critical electrical systems for these projects naturally stand to benefit. And Hind Rectifiers is one of those companies. Now let's talk about the growth. One of the first things that caught my attention was the company's revenue. In the latest financial year, Hind Rectifiers reported revenue growth of more than 50%. Think about that for a second. Many established companies struggle to grow even 10 or 15% every year. Growing above 50% is something you usually see only in companies riding a major industry tailwind. But revenue alone isn't enough. A company can increase sales and still fail to generate profits. That's why I always check profit growth as well. Here too, Hind Rectifiers delivered. Its net profit increased by more than 50% compared to the previous year. That tells me the company's growth isn't just about selling more products. It's also becoming more profitable. Another reason investors are paying close attention to Hind Rectifiers is its order book. The company has secured railway orders worth more than Rs 2 to 20 crore. Now, why is the order book important? Imagine you own a factory. If customers have already placed orders for the next 1 or 2 years, your future revenue becomes much more predictable. That's exactly what an order book tells investors. It gives visibility into future business. And that's something the stock market always appreciates. Now let's understand what makes this company different from many other railway suppliers. Earlier, Hind Rectifiers mainly supplied individual electrical components. While that was a stable business, the company has now moved into manufacturing complete locomotive propulsion systems. Why is that such a big deal? Because supplying an entire propulsion system generates much higher revenue than supplying a single component. Management has even indicated that the revenue opportunity per locomotive increases several times compared to the old business model. This shift towards higher value products is one of the biggest reasons analysts remain optimistic about the company's future. Another interesting development is the company's new copper conductor manufacturing facility. Instead of relying heavily on external suppliers, Hind Rectifiers can now manufacture more products in-house. This gives two major advantages. First, it improves profit margins. Second, it gives the company better control over production quality and delivery timelines. These may sound like small improvements, but over time, they can significantly improve profitability. What's even more interesting is that Hind Rectifiers is slowly expanding beyond the railway sector. As India builds more renewable energy projects, transmission infrastructure, EV charging networks, and data centers, the demand for advanced electrical equipment is expected to rise. Management has already hinted at opportunities in power infrastructure, including projects supporting modern AI data centers. If these opportunities materialize, the company's growth story could extend well beyond Indian Railways. Now let's look at the financial quality of the business. Whenever I analyze a company, I always look at return on equity, or ROE. This tells us how efficiently management uses shareholders' money. Hind Rectifiers currently reports an ROE of more than 20%. That's an excellent figure. Generally speaking, any company consistently delivering ROE above 20% is considered financially strong. The second metric I like is return on capital employed, or ROCE. Here again, the company performs well, with ROCE ranging between approximately 17 and 19%. That indicates management is using the company's capital efficiently while generating healthy returns. Another encouraging sign is improving cash flow. Growing companies often face cash flow problems because they need money to expand operations. Fortunately, Hind Rectifiers has been improving its working capital cycle, meaning the business is gradually converting more of its profits into actual cash. That's always a positive sign. Now let's talk about the risks. Because no investment is completely risk-free. The first concern is valuation. The market has already noticed the company's impressive growth. As a result, Hind Rectifiers trades at a relatively high price-to-earnings ratio. Whenever investors expect rapid growth, they are willing to pay a premium for the stock. But that also means expectations become extremely high. Even a slightly weaker quarterly result can trigger a sharp correction. The second risk is customer concentration. A significant portion of the company's revenue still depends on railway projects. If government spending slows down or project execution gets delayed, future growth could also slow. That's something every investor should keep in mind. Another factor is volatility. Since this is a small cap company, the stock price can move sharply in both directions. It's not unusual for quality small cap stocks to correct 20 or even 30% during periods of market uncertainty. That's why investors should never invest money they may need in the short term. So, what's my overall opinion? Personally, I think Hind Rectifiers is one of the more interesting infrastructure-focused small-cap companies in India today. The company is benefiting from India's railway modernization program, expanding into higher-value products, improving its manufacturing capabilities, and delivering impressive financial growth. At the same time, investors should remember that strong businesses don't always make good investments if the valuation becomes too expensive. That's why it's important to monitor future earnings, order inflows, and overall business execution, rather than buying purely because the stock has gone up recently. If Hind Rectifiers continues executing the way it has over the last few years, it could remain an interesting long-term story. But as always, do your own research before making any investment decision. This video is meant purely for educational purposes and should not be considered financial advice. I'd love to know what you think. Do you believe Hind Rectifiers has the potential to become a future multi-bagger? Or do you think the current valuation already reflects most of the growth? Let me know your thoughts in the comments below. And if you enjoy videos on fundamentally strong stocks, long-term investing, personal finance, and wealth-building strategies, Make sure to subscribe to the channel and turn on notifications so you never miss a future upload. Thank you so much for watching, and I'll see you in the next video.